And welcome to this week's On the Spot. My name is Kevin Hill here with JP Hampstead, and we are going to be talking about TRAC. You just saw the commercial, the promo right before we came on. We launched it on Tuesday, and you know what? I'm very excited about it. I've been excited about it for months now. As a former freight broker, it is the data I always wish I had at my fingertips, and now it's in Sonar, right, JP?
This is the first edition of On the Spot in the Market Dashboard era. Market Dashboard, of course, is the name of the app in Sonar that houses the track rates. Very excited. We think our rate assessment has a superior architecture, better granularity, better methodology.
Very poetic as always. JP.
Yeah, than some other providers, and just it's awesome. Very, very excited to talk about the market in this way.
I am too.
Which is starting to heat back up.
It is. Let's talk about the peak season forecast. Tony Mulvey made his debut on Great Quarter Guys yesterday with Anthony Smith talking about the passport research that we have out on a forecast for peak season. Q4 this year. What do we have?
It's a tight market despite OTRI dipping momentarily below 20%. It's back above 20% today.
Mm-hmm.
So we're at 20.14% of all truckload tenders being rejected by carriers on a nationwide basis. Expect that to climb really through November into the holiday, right? Into Christmas.
What do you think about, we're talking about peak season. I'm going to jump a little forward into Q1 of 2022. We have 83 ships sitting out at anchor. I saw that from Greg Miller maybe 2 days ago. He had an article out detailing that. So over 80 ships sitting out there. They're getting them unloaded. They're getting them off. Are they going to be in time for the holiday season where they need to be in a lot of cases? Is there going to be a lot of excess freight out there that needs to find a home that normally wouldn't be there because it'd already be delivered and on shelves? Are we going to see that? Is that going to bump up the first quarter of next year?
Yeah, that's an interesting perspective, right? Because normally you would want your freight to be sort of in your onshore or your surface transportation network, at least by now, right? Like by the end of October, for it to truly be ready for Black Friday and for fulfillment, by Christmas. That's a lot of the freight that's out there. Some of it's probably holiday freight. Some of it's probably even like older than holiday freight.
Halloween freight, maybe?
Yeah.
Maybe,
That's interesting.
Winter freight, right? Winter freight, if it's not on store shelves, if it's on store shelves by February, it's out of date. Right? If it's winter, whether it's winter apparel or winter goods or winter themed things.
Right. So you're kind of wondering if this yes, maybe it's like an extra pocket of inventory of freight coming ashore, but will the urgency be there? Will the demand be there to move it? What will be done with this? What effect will this have on Black Friday promotions, or post New Year's sales, things like those sorts of promotions. It'll be really interesting to see how I think shippers are mostly going to be managing for revenue and margin. Not they're not going to control the prices based on what they think transportation costs are. Inventory availability, yes, not necessarily transportation costs. So it will be interesting to see whether that demand falls off. We saw data come out, for consumer retail spending in October that looked really, really strong, despite or maybe partially because of inflation, right? If things cost more and you buy the same amount of stuff, retail spending goes up. But what that does tell us, though, is that even really, really high, really abrupt inflation hasn't dampened consumer spending yet. The other side of the coin, and waiting for this part to drop, is basically the household savings rate has returned to long-term historical norms. Mm-hmm. So the amount of going back in time during the COVID era, all the way back to like March of 2020, American households and consumers have been saving far more money than they normally would, and that dampened demand, right? Like for spending. Like some of it was services spending that wasn't there. Some of it was because of fiscal stimulus that they could save more. But regardless, if the historical norm is around 6.5 to 7% savings rate, it was getting up into above 15%, right? That's now back down to historical norms. While that was high and elevated, we could always point to that number as, hey, there's a lot of juice left to squeeze out of consumer spending. As the savings rate declines, that should free up extra money. That implies spending. Now that story has basically played out, and we shouldn't expect sort of artificially higher consumer spending driven by a return to normal habits. To be as pronounced as it has been.
Yeah, I think one thing we will see, certainly going into 2022, is comps, right? The comps are going to be tough for retailers, consumer goods, transportation companies. So there were some really easy comps coming into the fourth quarter of 2021. You're going to see tougher comps. 2022 are going to be all tough.
Yeah.
It's going to be tough, and that's going to be that expansion and growth narrative. We'll really see if we've reached the top of this market or not.
Yeah, I mean, that's true. We have seen rates, especially contract rates, run up a lot here in the middle of 2021. So like when we think about transportation providers and their financial results, especially year over year, it's interesting because it's really easy for companies with a heavy spot exposure to start beating their old comps really quickly because that changes first. But then later on, after growth in spot rates, it's sort of flat year over year, right? Contract rates hopefully are still moving up. So the sort of later cycle companies, and especially 3PLs and non-asset providers that can still be kind of raising their contract rates while spot rates may have plateaued or maybe even declining in some lanes. Those are really going to be the providers that benefit from the late cycle.
Yeah. Well, this is on the spot, so let's talk about some spot rates. I see you have written down some lanes there. What lanes are you tuned into this morning, JP?
I'm really tuned into LA to Dallas, actually. It's been a stable lane. Our market dashboard is returning an all-in spot rate of $4.11 a mile. Astronomical.
That is astronomical.
Interesting move, though, on the tender side of the market. We saw a 184 basis point move upward in the rejection rate out of LA overnight. So now the rejection rate out of LA is back up to 18.8%. It was below 17%. And so, to me, that could be a harbinger of even higher rates to come out of the West Coast, right? Especially if, and I don't want to get into the supply chain crisis, the bottleneck, the congestion, things like that. But as that works out, as it eases up, if in fact the ports are able to adjust their operations to increase their throughput, that's going to put more pressure on outbound capacity from the West Coast, right? And
I'm thinking the same way.
Are we seeing that now? Potentially, yeah.
And I think it's going to be a cycle. It's kind of been a cycle over the last few months. I think it's going to continue to be in the cycle and bleed into the first quarter. What's the second line?
Yeah, just Chicago to Atlanta, another classic, very dense brokerage lane that everyone moves freight in, right? $3.95 a mile all in. Also very high, a little bit more stable. Traditionally we expect, especially this time of year, West Coast outbound markets to light up prior to more inbound markets more inland markets like Dallas, Chicago, Atlanta. But those will be the next dominoes to fall.
They definitely. What's the next on your list here?
Yeah, well, other than that, just been looking at a lot of OTRI, right? Like looking at those moves. LA, like I said, up sharply. Dallas down a little bit to 18.6%. Atlanta up to 16.6%. And Harrisburg pretty stable, pretty flat, although it's higher than the national average, right, at 21.67%. So Harrisburg is often, even though it's like a Northeast market that a lot of carriers might be trying to get out of this time of year and be eager to leave, still has an outbound tender rejection rate above the national average.
That is interesting. On the Harrisburg point, Rich and I put that coffee down yesterday. We were talking. We had track data up and looking at Laredo, and that's another area that's really humming along as well.
Yeah, Laredo.
Laredo, and over the next week, I'm gonna dive into track myself, and look at different Midwest points, northbound and southbound Laredo, see what the trends are there, with traffic coming up and down, and seeing where the border situation is.
What I've heard is just that the overall shift in consumer behavior and freight movements, in the COVID era, has made the southbound and northbound routes into in and out of Mexico more imbalanced. So there's even more northbound freight. Right, even compared to the southbound freight, which makes securing capacity north out of Laredo a little bit tougher.
It is a little bit tougher. It's always been tough. It's a little bit tougher now. You have a little bit of nearshoring coming on. I mean, you have the bottleneck, so some nearshoring, and then you have rerouting of some freight. Teclo Garcia from Laredo, the economic development. He's on here on FreightWaves Now every once in a while, and we always talk about ships that are being rerouted and coming through Mexico and then trucked up northbound, which adds more to a bottleneck at that inland port right there.
Yeah, it's been fascinating to really watch how agile some of these shippers are in adjusting their freight flows, their volumes, kind of balancing their various ports of entry, right? Almost like a risk portfolio. Earlier this year, we were talking a lot about sort of like Walmart and how they had shifted away from Southern California ports and putting a majority of their containerized imports into Houston. That story has changed again, where now they have a much more diversified sort of deck of hand or whatever. They're moving freight through so many different ports now that none of them exceed 30% in terms of like Walmart, share of Walmart's ports, using everybody from Norfolk, Charleston, Savannah, obviously, as well, of course, as LA to Long Beach. But it's a much more spread out approach. It's fascinating to see, and I think it bears watching when you think about the really big importers like your Amazon's, Walmart's, Target's, Home Depot, Lowe's, Dole, Samsung, those people, and just really seeing like where they're putting the freight, especially as we get deeper into peak season.
Yes, and we are getting very deep into the peak season, and the bottlenecks are still there. The transportation, domestic truckload market is still as hot as ever. Going through TRAC, seeing the rates, it is they're just astronomical.
It's going to be interesting to see how the parcel carriers are able to scale up for peak. They traditionally add. UPS usually adds about 100,000 seasonal kind of flex employees. Looking at roughly 3 billion parcels shipped between.
We talk about truck capacity. We talk about driver capacity. Warehouse labor capacity is as tight as any of the other capacities that we talk about, and that's really going to hamper that LTL delivery, certainly. Well, JP, it's been great on the spot. We'll come back next Wednesday and talk about track rates again here on the spot.